Gold is about to do something it has only done 3 times in modern history. And right now, today, July 16, 2026, it is sitting at $3,999.60 an ounce, $1 below a number that the entire financial world is watching. That is not an accident. That is a coiled spring. Here is my prediction. Gold breaks $4,500 before the end of 2026, and I am going to show you exactly why, with the data, the history, and the specific catalysts that are already in motion right now. Not hope, not hype. A reasoned, evidence-based case with 3 specific price scenarios and the exact triggers for each one. Let's start with the moment we are in. Gold has been fighting to hold $4,000 today, not $3,800, not $3,600, $4,000. Think about what that means. A year ago, if you told someone in finance that gold would be consolidating above $4,000 per ounce, they would have laughed at you. But here we are. And the reason gold is struggling to crack higher today is not because the bull case has broken down. It is because US airstrikes on Iran are creating a specific kind of uncertainty that markets hate, the kind where number one knows if this escalates or de-escalates. Historically, when geopolitical shocks hit, gold spikes first, then consolidates, then makes its real move when the dust settles and the monetary damage becomes clear. That is exactly the pattern we saw in 2022 when Russia invaded Ukraine. Gold jumped to $2,070 in the initial shock, then pulled back to $1,800, then spent 18 months rebuilding before ultimately breaking out to $2,500 and beyond. The spike was noise. The consolidation was accumulation. The breakout was the real signal. We are in that consolidation phase right now. So what does the macro environment actually say? Let me give you the data because this is where it gets serious. The federal funds rate is sitting at 3.63%. That means real interest rates, which is your interest rate minus inflation, are barely positive right now. Real rates are the single most powerful driver of gold prices. When real rates are low or negative, gold wins, every single time in modern history. In 2020, when real rates went deeply negative, gold ran from $1,500 to $2,075 in 7 months. Right now we are approaching that same setup from a much higher base price. Here is data point number 2, and most people completely overlook this one. US CPI sits at 332.568 on the index. That number has not meaningfully reversed. Prices are still climbing, the dollar is still being eroded, and gold is the oldest hedge against exactly that erosion. Every single percentage point inflation stays elevated is another brick in gold's foundation. Data point 3, and this one catches most investors off guard. Real GDP growth is sitting at 2.1%. That sounds healthy, but here is the thing most people completely miss about what moderate growth actually does to gold. When GDP growth is moderate but not strong, the Fed has political cover to cut rates. They are not fighting a hot economy. They are managing a soft landing narrative. Rate cuts mean lower real rates. Lower real rates mean gold goes higher. The math is that simple. Data point 4. Silver cannot crack $60 today despite the geopolitical backdrop and gold at $4,000. The gold to silver ratio right now is roughly 66 to 1. Historically that ratio compresses hard during the later stages of a precious metals bull market. In 2011, silver ran from $18 to $50 in under 8 months as gold was topping out. When silver starts playing catch up to gold, it historically signals that retail investors are flooding into the metals complex, which is the final accelerant for gold's price. Silver lagging right now is actually a bullish signal for gold. It means we are not at the euphoria stage yet. There is still fuel in the tank. Data point 5. Bitcoin and Ethereum are rising today. Now you might think that is competition for gold. But look at what happened in 2020 and 2021. Gold and crypto rose together because they were both responding to the same cause, excess money creation and dollar debasement. When crypto rallies, it is often a leading indicator that the debasement trade is being repriced across all assets, and gold eventually catches the same wave. Data point 6, and this one will surprise you. Most people ignore home equity loan rates when they analyze gold. They shouldn't. HELOC rates are tied directly to the federal funds rate, and the fact that they are still high enough to be headline news tells you one critical thing: the Fed has not made its big move yet. When they do cut, and the market is pricing multiple cuts before year end, that is when gold's next leg up begins. Every 25 basis point cut historically has added between $50 and $80 to the gold price within 90 days. Data point 7. U.S. airstrikes on Iran. Let's not sugarcoat this. Military conflict in the world's most important oil corridor is not a minor market footnote. Iran produces roughly 3,300,000 barrels of oil per day. Any disruption to Strait of Hormuz traffic, through which about 20% of global oil passes, would cause an energy shock. Energy shocks are inflationary. Inflation is the enemy of fiat currency, and gold is the oldest enemy of inflation. If this conflict escalates, $4,500 becomes a floor, not a target. Data point 8. Central banks globally bought 1,037 tons of gold in 2023 and kept buying at near-record pace through 2024 and 2025. These are not retail investors panic buying. These are sovereign treasuries making strategic decisions about dollar reserves. China, Poland, India, Turkey, all accumulating. When the institutions that actually hold the global financial system together are quietly moving into gold, that is the most important signal of all. Now let me give you the 3 scenarios. Base case, the Fed cuts rates 2 to 3 times before December 2026. The Iran situation stays contained. Inflation holds in the 3% range. Central bank buying continues at current pace. In that scenario, gold reaches $4,500 by December 2026. That is a 12.5% move from today's price of $3,999.60. Historically a very achievable target in a 5-month window during a confirmed bull market. Bull case, Iran conflict escalates, oil spikes, inflation re-accelerates. The Fed is forced to choose between fighting inflation and supporting a slowing economy. They choose growth, they cut anyway. Real rates go negative again. Retail money floods into gold after silver breaks $60 and the headlines hit mainstream media. In that scenario, gold tests $5,000 before year-end. It has happened before. From late 2023 to early 2025, gold doubled in roughly 18 months. A run to $5,000 from $4,000 is exactly the same percentage move as the run from $1,800 to $2,500. It would not even be the biggest move in this bull cycle. Risk scenario, the Fed gets spooked by sticky inflation and holds rates flat or hikes. The Iran situation resolves quickly and oil drops. Dollar strengthens on safe haven flows into treasuries. In that world, gold pulls back to $3,500 to $3,600. That would be a painful correction, but it would not break the long-term bull case. It would be a buying opportunity, and the historical pattern suggests every major gold pullback in this cycle has been bought aggressively. Here is the summary. Gold at $3,999.60 today is a coiled spring. The base case is $4,500 by December. The bull case is $5,000. The risk case is a dip to $3,500 that the data suggests would be temporary. 8 macro signals are all pointing in the same direction. Low real rates, persistent inflation, geopolitical risk, central bank accumulation, dollar debasement, a silver ratio that says we are not at peak euphoria, and a Fed that is more likely to cut than hold. You do not need all 8 to be right. You need 4 or 5 of them to play out, and gold will do the rest. If you want to track exactly how these targets develop over the coming months, subscribe to this channel right now. Every week we update the price targets, track the key indicators, and tell you when the signals change. Most finance channels give you opinions. We give you the specific numbers, the exact triggers, and we update them every single week. If even one of those 8 signals shifts, you will know about it here before the mainstream media catches on. Hit subscribe, turn on notifications, and I will see you in the next one.